Hey, what's up you guys? Today I want to talk about FHA loans and why you need to get out of it now. First, let's talk about why people have an FHA loan. So at least for me in my case, the 6% closing cost assistance was a really big deal for me because one, I didn't have a lot of cash, and also the 3.5% down payment. I mean, that's really low to get a house. And so it's very enticing for a lot of people. Another reason could be the fact that you may have a low credit score. FHA only requires 580 or higher credit score, and that drives a lot of the folks that have less than ideal credit to kind of get that loan to get their first house. But none of that really matters anymore because you already have an FHA loan and you're really curious why you need to get out of it now. So let me explain. Now, the first reason why FHA is so bad is because when you first got your loan, you were actually charged what's called an upfront mortgage insurance premium. And what that is just a requirement to get the loan, and it's a percentage of the mortgage that you took out. And so if you took out a $200,000 mortgage, you were charged a 1.75% or $3,500 mortgage insurance premium. And so literally what they did was either you could pay it up front with cash, which again, most people didn't have if they got this kind of loan, or they just tacked it into your loan or your closing costs. And so most likely they tacked it into your closing costs, and either the seller paid for it or they just rolled it into your loan and increased the principal balance. The second reason why FHA loans are bad is because it has a PMI for the life of the loan. And they call it something different, MIP, but essentially it's the same thing. But the only difference is it never drops off. Now, if you were lucky enough to have 10% down, which I don't know why you went with FHA to begin with, maybe credit score, it drops off after 11 years, and that's a pretty long time. And if you didn't put 10% down, it will stay on the loan for the life of the loan, and so you're stuck with that $50 to $100 payment for 30 years. Whereas a conventional loan, it drops off after you hit 80% loan to value. I mean, it doesn't drop off automatically until 78%, but you can request to drop it off at 80%, thereby saving you $50 to $100 a month on your monthly payment. Now, the third and last reason why FHA loans are bad is because that MIP and that upfront mortgage insurance premium that you're paying is not even tax deductible. And so you're basically paying it for nothing. Back prior to 2017, all of that upfront mortgage insurance premium and PMI payments were actually tax deductible, and you can actually deduct the MIP and the upfront premium as if it was mortgage interest. And so there was a little bit of a tax write-off for that reason. And so sometimes the FHA will have lower interest rates, but have an MIP part of it, and so it kind of just ends up being the same thing. But nowadays, post 2018, those tax deductions are long gone. You cannot deduct any PMI or MIP or upfront mortgage insurance premium anymore for any loan, for that matter. All right, let's talk about why it's wise to refinance to a conventional loan. Even if it extends your loan by 5 years or so, it's still going to be worth it in the long run. So first off, your credit should be a lot better now than it was 5 or 10 years ago when you got your FHA loan, mainly because you've been paying your mortgage, hopefully. And if you've been doing that, then your credit score is probably really high at this point. So you should qualify no problem for a conventional loan. Another reason why you can consider doing this is, if you weren't at 80% loan to value before, which could be the case, when you refinance, a new appraisal will happen. And if you bought your house in the last 5 years, it most likely has appreciated, quite a bit. And your new value and your current balance is going to put you well below the 80% threshold for PMI. So you will eliminate your PMI by refinancing to a conventional loan. Now, your property taxes may go up a little bit because it has to reappraise the value, but I think overall you're still going to save a lot of money. Now, if you're wondering if you have to pay closing costs, if you check out the link below, or the lender Box Home Loans is who I recommend you try. Look at their rates and look if you can find a loan that has a lot of lender credits. And what that means is they're going to pay for most of your closing costs. And if the interest rate makes sense, even if it's similar or close to what you're paying now, you ideally want it to be a little bit less because you are extending the loan. You should be able to get away with a no cost, quote unquote loan. And what that means is, you shouldn't have to pay any money out of pocket. Now, you may be surprised that you may have to pay escrow, and you have to pre-fund a new escrow account. Now, just be aware that when you do that, let's say it's $2,000 that they're asking for you to pay. Your other escrow account in your FHA loan will eventually close when that loan gets closed. And so you will get refunded that amount back. And all the escrow account is doing is just saving money and setting it aside so that when it comes time to pay for your property taxes and homeowners insurance, that it has the funds to do so. So you've already been doing that in your FHA escrow account as well, as you're making your monthly payments. So when this new loan funds, you'll have all those funds in there that you'll have to kind of provide. But in your FHA loan, that escrow account will close, and then you'll get a check back from that escrow company that was managing that money. So it's kind of a wash. And if everything works out correctly, hopefully you have, a lot more money available to you. Your cash flow is a little bit more positive now, and you're not paying, irrelevant charges towards your loan. I mean, you're still paying interest, but everybody has to pay that. But you're not stuck with a PMI payment for the life of a loan. It kind of reminds me of like HOA fees. It's stuck with you forever, right? Fortunately, in this case, you're allowed to kind of refinance out of it and get a regular conventional loan and not have to pay that ever again. So hopefully this video was helpful. Go out there and get some quotes and see if you can get out of your FHA loan. Hopefully you'll save some money. If you did, let me know down in the comments, and please subscribe for more videos in the future.